Okay, hello investors. This is Don Vandenbord, Portfolio Manager with Revere Asset Management, and welcome to today's Lunch and Learn. This is our fourth of 2020, the 14th overall, going back to August of last year. And today's webinar is entitled Bear Market Recovery Plan, where we're going to review the past 6 months of what went on in the market, focusing primarily on the last 3 weeks as we initiated our plan to re-enter the market after a ferocious bear sell-off that saw the S&P drop as much as 35% from its high. I liken that 35% drop to a head-on collision, but I also am proud to say and proud to report that our client suffered the equivalent of a fender bender as we implemented our plan to exit the market, stayed clear of the vast majority of the drop down, looked for entry points off of the bottom, exercised those entry points, and now we're reaping some of the benefits of that approach. As you can see today, really what we do is we look for the leaders. The S&P 500 is down 2.7%. Our growth portfolio, a composite of them, is up about 0.7% today. So that's the kind of outperformance you can get when you focus on the best stocks and focus on the right time for entering them with low risk entries. And if they don't work, get out of the way, give them a little bit of room to work, take profits along the way, and try to create as smooth an equity curve as possible is what we do for our clients. So very quickly, our website, revereasset.com. We also have a YouTube archive where all of these lunch and learns are. Just go to YouTube and search for Revere Asset. And a reminder, these are for educational purposes only. We're not suggesting that you buy or sell anything. We're presenting a sound approach for a common sense approach for addressing the markets, which means we participate in uptrends and get the heck out of the way in downtrends. And as I mentioned, today's topic, bear market recovery plan. I'm going to review how we re-entered after recognizing the bottom, because if we had a motto at Revere, it would be, it's not how much you make, it's how much you keep. And then at the end, we'll do Q&A and charts on request. So let's get started here with a look at our topics. And a little bit of background, previous bear market stats. This is really the first webinar we did in January of 2020. The first one in 2020 in January was entitled "Stay Clear of the Bear." And what we did is review stats from the best from the last 11 bear markets, and we certainly have a 12th after this one. And I also want to get rid of some of the myths on Wall Street of every time you're on CNBC, they trot out a buy and hold only manager and they bring up the nonsense of what if you missed the 10 best days. Well, we have hard stats that show the 10 best days are intricately tied to the 10 worst days, because they ironically occur when you're in bear markets as volatility enters the picture, and so does FOMO being fear of missing out. And as far as I'm okay, my portfolio is diversified. If you witnessed what went on at the late February and the beginning of March, where there was a very obvious liquidity event, everything had to be sold: stocks, bonds, gold. You don't have a choice when you get a margin call of what you have to sell. You have to sell a portion of everything, and it really is a case of the baby going out with the bathwater. And these situations only occur, this analysis that we did of the last 11 bear markets, the market does not get into serious trouble unless the S&P breaks below the 200-day moving average. If you're not familiar with that is, that's just a summary of the last 200 closes in the market. You add them up, you divide by 200, and you take a look at where the current price is compared to that average. And just applying some simple rules to avoid big losses, if you exit when you get a weekly close more than 1% underneath there, and you re-enter if you get a weekly close 1% back above, the results of the last 11 bear markets is on average the loss was 33.3%, and this 12th bear market, the one we're having right now, the drawdown is 35%. These stats are right in line with historical stats. The high to the sell was 11.2%. In this case, it was about 13%. The average sell, so where you exit to where the market actually bottoms, averaged 22.7%. In this case, it was 26%. And yet to be determined is where you would re-enter using this 1% close above. On average, the re-entry is 9.4%. Right now, we actually would be re-entering slightly above where we would exit. But if you can avoid 26% of downside pain on your portfolio to re-enter 1% higher, that's well worth the trade-off to me. And that's really what differentiates us at Revere, our approach to the markets. As I mentioned, participate in the uptrends, stay clear in the downtrends. I trademarked the term growtection. That's the primary growth portfolio that I run, and it has rules for getting in, rules for getting out, rules for investing in the best and the strongest stocks in strong markets. And the concept of sequence of returns is something that you rarely hear addressed by the mainstream Wall Street, because the market returns historically on average about 8% a year, but you don't get 8% every year. And this is one of those situations, especially where you're approaching retirement, you can't afford back-to-back years of 20% losses, because that's your nest egg. That's what you're going to be tapping during your retirement years. And that's why sequence of returns is such an important concept. So moving on, the next thing I'm going to address is the prior 6 months in the market. We're going to take a look at the rally, the top, the warnings, and the escalation lower and the bottom. And let's go to a chart right now. This is, let's bring up the S&P 500 and take a look at a monthly chart. And you can see here really what our approach is designed to do. This goes back to 1994. I know that there have been 11 bear markets. This shows 4 of them. The big bursting of the internet bubble, the financial crisis. This was Q4 of 2018, when the Fed seemed out of touch with what was going on with the market, and the markets panicked. And now, of course, what's going on now? Our approach is designed to participate during these uptrends, but get the heck out of the way when you're in these severe downtrends. So that's a monthly chart. If you look back at a daily chart now, really what we're looking at is, first of all, let's take a look at the run up. A nice rally started in mid-October 2019. So these lines on this chart, the black line is the 200-day moving average. That's the line of last defense. When you start acting or behaving or hanging out underneath there, that's your last chance to get out of the way. The red line is the 50-day moving average. We use that as an intermediate term trend. And the green line is the 21-day exponential moving average, and we use that as our short-term trend. So really a nice rally started here, October 2019, all the way up through the top in mid-February of 2020. This was a very nice rally. We captured some very nice gains there. Excuse me. But then we started to see some signs of discontent in the market, let's say. And really it started with some talk about the coronavirus, which really started in mid-January. And this big gap down here on 224, that was where the coronavirus really started hitting home. Stocks reacted negatively. It was a weekend. We had a big gap down. And at that point, we broke below our we actually started selling some things up here, because you can see volume picking up here. There's something called distribution days that we track, and basically that means the market is going down on higher volume. And when you get a cluster of these, it's very important to identify them and get out of the way. So we started selling some up here. Once we broke the 21 EMA, the green line, we lightened up considerably. Once we broke the 50-day moving average, we sold a bunch more. And when we got out under the 200-day moving average, we were virtually all out of stocks, and at that point just holding bonds and gold, as those seem to be holding up very well in their traditional safe havens with the market. So let's go back now to the top, the warnings, the escalation lower, and the bottom. So this day, 228 was actually that first trigger. This is your first weekly close This is a Friday. This is your first weekly close below the 200-day moving average. That's the black line. So that would have been using those rules that I said in that review over the last 11 bear markets. That would have been your signal to get the heck out of the way. So the next week we bounced up, and then we ended up closing below it. And from this point to this point is the 26% that I was talking about. So from where we exited to the bottom, this was the 26% of pain that was avoided by being out of the market using those rules. So at that point, we're looking for a re-entry point. We don't want to be in while the market is continuing to go down. What we're doing is looking for some reason to get back in, some sort of a normalcy. And the Fed fired a big bazooka over the weekend here, where they started talking about how they would basically be buying all types of bonds. They would do whatever they could. They cut the interest rate first by 50 basis points, then by another 50 basis points. And initially the market panicked and it made this low. But the next day it gapped up, and as of right now, this 2192 level is the low that has been put in. So our process, we look for the best stocks in the best sectors and when we can re-enter them. There's a concept called a follow-through day, popularized by William O'Neill. He's the founder of Investors Business Daily, and his system is a great one for participating in bull markets and avoiding bear markets. And for at least 4 days off the bottom, you look for an up day on expanding volume. So this was really a signal to start dipping some toes back in the water. This 3-day scare here, this was the last attempt to get all of the bears out and embolden the bulls, but all that ended up being was a false breakdown. And then this next gap up, as it broke above this level here, this prior level here, and more importantly, this green line, that's the 21-day exponential moving average. This gave us a signal to buy, to start delving even more into the market. Keeping in mind that we do still have some hedges on, and we've been talking about that in our nightly videos. So you see the market trying to get higher. We had a gap down on Monday, another gap down today, as some earnings reports are starting to come in and indicate that this really may be a lot worse than people think. So what's important now to monitor as we have some exposure is A, where are our stops in the things that we own, and B, what is the overall market doing? Because the first sign of a change in character, right now the character is we're trying for a short to intermediate term rally. The first change in character would be a break below Monday's low. That would be a change in character because as we've started this process, we've been making higher lows and higher highs. That would be the first time we made a lower low below with a break below Monday's low. So that's the first thing we're keeping an eye on. The next thing we're keeping an eye on is this 21-day exponential moving average. Any support that we would expect the market to come in should happen right around this level, and that level is around 2681. Now this is trending higher, so tomorrow maybe closer to 2700, but when we get down into this area, the market needs to hold that area in order to stay in this short-term uptrend that we're in. Now I'm going to go from the S&P 500 to the NASDAQ 100 because this has really been by far the strongest of the 5 indexes that we track here. You can see this one not only got back above the 21 and above the 200, but also above its 50-day moving average. The stocks that make up the NASDAQ 100 are primarily tech stocks, and that's where we've been focusing our approach as we dip toes back in the water. And what I'm going to do is a post-trade review of 20 or so entries that we made, point out the rationale for why we're doing it, and explaining how you can participate in the market even while you have minimal risk on the table as you're trying to come off the bottom, because as we know, this really isn't a healthy market, despite the fact that this looks okay on the NASDAQ 100. And if you want to see something that's really unhealthy, here's small caps, which we've been completely avoiding. They actually dropped over 40%. And even now are below that short-term moving average, which is the 21-day, the short-term line in the sand. So extreme weakness on there. I also want to point out this blue line here that I'm hovering my cursor over. That's called the relative strength line. And any chart that I bring up, that chart, this line reflects how the investment is doing versus the S&P 500. So for example, if I bring up SPY, all SPY is an ETF that tracks the S&P 500. So you would expect that to be fairly straight, and it is. If you bring up the NASDAQ 100, the QQQ, you can see how this line is trending up because during the rally, it outperformed strongly versus the S&P 500. Even during the correction, continued to go up. Now, a little bit of a loss in relative strength over 2 weeks while some money flowed into junk that was coming off the bottom. As we came off the bottom, that's very typical. But now over the last 3 days has been fantastic outperformance by leading growth stocks, and that's really been reflected in our portfolios in-house here. So we're focusing a lot on how this behaves if it comes back into this red line, which would be the 50-day moving average after playing around near this 200-day line here. So I showed the S&P 500, I showed the NASDAQ 100, I showed small caps. There's the escalation lower and the bottom. So now the recovery plan. I talked about the follow-through day. Let's talk about our reentry criteria. And the first bullet item that I have here is relative strength leaders. I just mentioned this relative strength line. So while the market is correcting, if you're familiar with the videos that I put out, I have a 21 over 21 list, and all this is a list of the leading stocks that are holding up well above their green line. In other words, this 21-day exponential moving average. I really heavily rely on that as a significant marker of strength on an individual holding or in an index. Another way is to look for, the kind of the Titanic companies that run the American economy, stocks like Apple, Amazon, Netflix. If you can get them near their 200-day when they come off, that's a very good entry point. And then finally, if stocks report earnings and they gap higher, that's a sign of extreme strength. So these are really the 3 types of leaders that we're looking for to re-enter. So now I want to bring in some trades that we made and what our thought process was for re-entering. I'm going to be dragging this from off the screen. And these are sorted. These are sorted by the buy date when we re-entered. So the first, what I did is I had a list of what I called the Elite 8. These are stocks that had been showing relative strength. They're really kind of titans of their industry, although obviously GSX isn't. But these were 8 stocks. These are the top 8 that I really wanted to attempt to get into. If the market was improving, I expected these to outperform the market. So AMD, Vertex, GSX, Shop, NVIDIA, Amazon, Microsoft, Netflix, and Dexcom were the 8 that I had on my list. So started buying them on 325, and we're going to go through these, take a look at how they were acting, why I bought them, how they continued to act, and very obviously some of them didn't work out. And that's something that you absolutely have to understand. All of your trades are not going to work, and the quicker you realize they're not working and you get out of the way, the better off you're going to be. So here's Advanced Micro Devices. This was bought on 325. So first of all, let's note the bottom. The bottom was 323, okay, which was right here. Now notice 323 is the bottom. AMD didn't make a bottom that day, so that tells me that it's showing relative strength. This line trending higher also shows me that it's showing relative strength. I know the story, and again, I would expect it to outperform. So took the first position in that, added some to it on 327 when it continued to show strength. Yesterday, when stocks just started really getting ahead of themselves, I made a couple of sells, took some money off of the table. Growth stocks had gone up 2 days in a row very strongly, and to me, it's important to just lock in some profits along the way because of how volatile these types of markets are. So took a little bit off, locked in a 16% gain. And I'm still holding some. These prices were as of 11 o'clock Eastern time. The percent that I'm still holding is up about 18%. Also remember, these are a third to a half size positions because the market isn't in a complete bull market. I can take a position as high as 8 to 10% of the overall portfolio, but really not something you want to do when the market is like this. So they're small positions. They're taken at a low risk entry point. Stops are in place, and we also have hedges on. As the market goes through different resistance levels, we can either add to or subtract to those hedges to try to smooth out the overall volatility. So the second buy on 325 was Vertex. This has been, again, one of my Elite 8, one that I've been watching very closely. Entered on 325, so right here. Again, here's the 200-day line, never broke below it. Look at the blue relative strength line. Very strong uptrend, and this thing moves so quickly that it moved too quickly. First of all, in a type of market like this, when you break out, it's very hard for breakouts to go higher. So I actually locked in the whole position that day, 16% gain. When it pulled back to the ADMA, I re-entered it the very next day, and I'm letting that ride right now. Small gain in that re-entry, bought it around 240. It's around as you can see, 256 now. So let's talk about two that didn't work here. That's right, Revere asset. We talk about things that don't work. GSX. This is a Chinese stock, and basically with everything locked down in China, this is an online education stock, and showing extreme relative strength. This is what attracted me to it. Look at the relative strength line. But then a couple of weeks ago, let's see where I got stopped. I got in on 325. I sold it on 4.2. 4.2 is right here. Do you know what that coincides with? That was the date that Luckin Coffee came out and announced were accused of fraud and pretty much admitted it. GSX gapped down that day below the 50-day moving average, and I just closed it out, took my 9% loss, and I was very happy to move on. Another one that I entered, this has come back, but this is one of my Elite 8 that just didn't work at the time. Shopify entered on 325, exited on 330 for a 10% loss. So no, they don't always work regardless of the story, but 325, this was looking pretty good. Had the relative strength, but look how that rolled over and went all the way as low as in the 330s. Now it's come back, and this is back on my list of things to watch. But at the time, I'll take my lumps and get out on Shopify. So 327, another addition, NVDA. Another situation where it's showing relative strength, pulled back a little bit. 327, here was the entry, broke below intraday, but for the most part held the 21 and is now approaching new highs, breaking out of this cup and handle. Amazon, we entered this both in the stock and ETF portfolio and the growth action portfolio, and this is just behaving better than we ever could have imagined. Got into it on 330, around 1950. I think Tim actually got in a little bit earlier than I did on this. 330, again, once it got back, this is a Titans above the 200. This is that type of buy. And plus Amazon, I mean, they've hired 175,000 people during this coronavirus issue. Do you think that that's going to carry over when things return to normal? I'm going to say yes. It's at all-time highs. What else can you say about it? So Amazon right now, we're riding at 22.90. We're riding about an 18% gain on that. Another one, Microsoft. Are people going to let their Microsoft Office subscriptions lapse during the coronavirus? No, if anything, with more work from home and people are going to be using it more. You can see by this giant blue ball here on the chart, this means that relative strength is at a new high before price has made a new high. And again, same characteristics on this, increasing relative strength. A Titan broke below the 200, got back above it, and took my entry there on 330. One that I wish I had, but I don't, but Tim does and has been cleaning up on in the stock and ETF portfolio is Netflix. I had some other ones, just decided not to pull the trigger on it. Tim entered this on 330 and 425, 432 now, so up almost 15%, over 15% on this. As you can see, this just skyrocketing higher. Yeah, people are sheltered. They're going to be watching Netflix. And then finally, the last of my Elite 8, Dexcom. This is a situation of just knowing the story. This is diabetes monitoring. Very harsh sell-off. First of all, it had this big gap up twice in a row on earnings, so that got my attention. I like stocks like that. They tend to be the next big leaders. Sold off with the rest of the market. This big harsh sell-off is just part of the mid-March, early to mid-March liquidity crisis. But look where it stopped, the 200-day moving average. Got back into it on 331. So around here when it came back above the 50-day moving average, and now probing all-time highs, Dexcom. Some of them we've just done a scalp on. Teladoc, big winner, but some extreme volatility in here. Seems to be calming down a little bit, and some of the volume calming down. These are the types of things where we just scalp like a couple day gains on this. Entered 331, sold on 4.1 for a quick 5% gain. DocuSign, another one, entered on 4.3, sold on 4.6 for a 7% gain. Because although they've been winners in here, they've been very volatile too, and it's the type of thing where you have to buy the strongest stocks on weakness. Otherwise, you end up buying up here near 90. In fact, Tim was in this. He caught this very nicely off the 50 and sold it in the mid 90s. Pulled all the way back to 78 within a couple of days. Then we re-entered it, took our gain in a day or two, and now again it's at all-time highs. You can't be perfect and own everything, but at the time we're very happy for that. So I'm not going to go through every one of these, but let's talk about a few more and how they were played. Okta, I noticed that, look at the relative strength line again, and also look at CLOU. This is a cloud ETF, and notice how it was outperforming while if you just look at this chart and this blue line wasn't on here, you would think that this stock just absolutely sucks. And it did, but it only sucked as bad as the market did. The S&P 500 is a lot less volatile than a cloud computing ETF would be, so you would expect a bigger sell-off with this. And note how, while we're at the bottom here, these cloud computing stocks started to act better than the market. So that led me to a bunch of cloud stocks that I had on my list, and two that I took entries in were OKTA. This is near new highs. I took a third of this off yesterday with a 12% gain, sold partial. So just a piece of this that I own right now. Veev, VEEV. Same situation, near all-time highs. You've got relative strength at an all-time high. Also, again, relative strength, that's the secret weapon that really I use in the Grotection portfolio. And we also bought Zscaler. Both Tim and I bought this, and this has been one that's been acting fantastic as it broke out of this tight range here. A couple more, I re-entered Vertex on 4.6 after that sale up here. Actually, I sold it on 4.6. I re-entered it on 4.7. That date is wrong. Yeah, no, here it is, 4.7. Domino's Pizza. This is something that Tim owns. This is in the stock and ETF portfolio. Bought it around the 350 area here and continuing. Again, look at the relative strength here. Waning a little bit lately, but trending up over the last week and a half as it consolidated above this key 21-day exponential moving average. Something that's acting very strongly that I just took all my profit in yesterday, but this is very high on my list to rebuy, is Livongo Health. Again, note the relative strength. Just got too extended, wrapped it up yesterday for a 17% gain, but it's on my list of things to re-enter. Another GDX, I bought Nugget and scalp that for a 2-day 17% gain. You've got to lock in some profits on these when they really start running before they give it up, because it's very hard, even in a market like this, unless we're in a strong bull. Once things approach all-time highs like this, they really tend to reverse. That's one of the key differences between a consolidating market and a strong bull market. So a couple other things I'm in is Net. This is Cloudflare. Again, big relative strength consolidating above the 21-day exponential moving average, and fasterly FSLY. This is something you're going to start hearing a new term called edge computing. It's really too hard to explain concisely. I'm not an expert on it, but I know that Fastly is a leading edge cloud company. I liked the insider buying here. I liked the relative strength during the sell-off, and now the relative strength is kicking back in, and it got above its key moving averages. So that's something I'm keeping an eye on. This is one of probably the most speculative thing I own. Don't know if it's going to end up being a big leader or not. But that is that's pretty much everything that we've traded in-house since 325 when we started getting back in. And the way that you can participate, as I said, when you've got relative strength stocks that are going to outperform the market and you can offset them with hedges. Let's again take a look at, there were some hedges that we entered. One that we entered was when we had a failure here on a breakout in the QQQ. But sometimes you can hold on to a piece of this as you're adding on to the leading stocks. Now, think about it this way. I've had a couple of people ask me, why don't you just stay in cash? What's the point in being hedged? Well, when you have 3 days like Monday, Tuesday, and Wednesday, and growth stocks has far outperformed, if I'm in cash, all of a sudden I'm trying to make 3, 4, 5, 6 buys as things continue to get more and more extended. And that's just a recipe for a normal pullback, getting you shaken out of stocks like this. So if I hadn't owned Vive down in here and have it hedged, I certainly don't want to be buying it after 2, 3 strong days up like this. I'd rather hold it, reduce the hedge as this starts to get higher. So it's really the approach of owning the strongest stocks on weakness with a hedge in place to reduce some of your volatility. That way you've got the stocks in your portfolio. You're limited in your beta, which means how it's going to perform versus the S&P 500. But at the same time, because these are strong relative strength acting stocks, if they're going to work, they're going to far outperform. The average growth stock outperforms the S&P 500 by 2 to 3 times during their strong run. So those are the types of things that I want to have in my corner. Think about it this way. So think about it, you're in a swimming pool and there's a bunch of mini inflatable balls around you and you're just gathering up and you've got your arms around maybe 6, 7, 8, 9 of these balls and you try to go underwater. They're going to hold you up. Those types of stocks should hold up near where you bought them. And then think as you go underwater and you just let go of them, how they spring back to the surface and jump above the top of the swimming pool. That's the equivalent of the stock breaking out and going higher. And once it breaks above there, that's you taking your hedge off and allowing these to go higher and take advantage in the bottom line in your portfolio. Now, again, ideally, let's go back to the S&P 500. This is the picture of an ideal market. We're far from an ideal market right now. Really, you want the 21-day, the short-term moving average above the intermediate term, that's the red line, the 50-day moving average, and you want both of those above the 200-day moving average. Right now, we've got price above the 21, but still below the 50 and below the 200. And also it's important that the slopes of the line are important. So those are heading lower. That's not positive. The QQQ, I mean, this is the closest to perfection as we can get, but you'll notice the 21-day is still below the 200 and still below the 50, although the 50 hasn't crossed back below the 200, and the slope of the line on the NASDAQ 100 is still heading higher. That's why we've been focusing our buys in NASDAQ 100 type stocks, and then again leaving a hedge in place to allow the stocks to outperform, but at the same time limit the volatility, because sometimes, like last Tuesday was a good example, it was a complete opposite of the action we've seen the last 3 days. Over the last 3 days, growth stocks have far outperformed the market. I mentioned that in my video on Monday. It happened again on Tuesday, and it's happening again so far today. I mentioned in Monday's video, I keep 150 stocks constantly streaming, their quotes constantly streaming, and I can see at a glance of my top 40 stocks right now, 30 to 35 of them are green. And that tells me all I need to know about how growth is outperforming. And also the MTUM, that is a momentum ETF, that is outperforming double. It's down 1.5%, while the value ETF, VLUE, is down almost 4% on the day. And again, the small caps continue and mid caps continue to get wiped out. So that's it. That's a summary of the plan. I can take questions, and got quite a few questions in here. Let me start that. So I'll take questions and any chart requests. Let's see. Oh boy. Josh Brown, we're not fans of Josh Brown and his management company and the approach that they take to the markets and how they go on TV and act like they talk about stocks when they don't buy individual stocks. They're just pie chart buy and hold salesmen. But let's take a look. He said I should buy Starbucks. Well, if you own Starbucks, you're down 94 to 71, so you're still down 30% off its high. It's gotten back above its 21. Starbucks got a big lift when Luckin Coffee, because Starbucks is trying to establish a big presence in China when Luckin Coffee came out as a fraud, below the declining 50-day moving average. There's certainly worse stocks than this, but if you're fine with holding something and losing, it went from 94 to 50. If you're fine with losing 45% of your money, I'm not. We're not at Revere. We would never hold anything like this. But the time to get out of this would have been the worst. At worst, the time to get out of this would be on this break below the 200-day moving average. Boeing looks like a value play. What are your thoughts on that? We don't do value plays unless it would be one of those titans of industry that I talked about getting back above the 200-day moving average. But you can see how Boeing has acted since it was up here at 375 every time it comes into the 200-day moving average. It failed there. It failed there. This is really your last chance to get out when it failed there and then completely dropped lower. Relative strength of 7 means that 93% of all stocks have outperformed it over the last year. See the relative strength line going straight down, bottomed at 89. I realize it almost doubled in the span of 2 weeks here, but if you bought it here at 186, it's now at 137. You're down 25%. Not the type of stock that we traffic in at Revere. I'm new to the process. I found you on Twitter. Why not just buy and hold? This is America. It'll come back, right? Great question. If you look at this chart, you know, two people can look at the same chart and see different things. I look at the chart and I see an uptrend, and yes, it always has come back. I also see instances where people lost 50%, 57%, 20%, and 35% of their money if they just stayed in. How much larger can you compound if you get out up here? Recognize the time to get back in, let it ride, recognize the market's not healthy again, get out, ignore all this pain, wait till it does get healthy again, ride this whole thing up, take some off the table here, get back in, take some off the table here. The power of compounding by not losing 50% allows you to grow your capital so much higher, not to mention the fact that you can sleep at night if you follow the approach of the market, the signals that the market gives off as far as it being healthy or not healthy. I like to use the analogy of the check engine soon light on your car. When you're driving and it comes on, you don't know how bad it's going to be. It could be as simple as you just need to change your oil, or it could be that you're going to have your transmission replaced. The 200-day moving average is the equivalent of you taking your car into the service so that they can diagnose and repair what's happening. If it comes back immediately, fine, you're out with minimal damage. If you need a new transmission, that's the equivalent of dodging this big 26% loss here. Not to mention the ability to sleep at night. And if you've got a buy and hold advisor, and that's all they can tell you is to think long term, well, if you're approaching retirement, you can't afford big losses like this. I've been sitting at home watching CNBC and Bloomberg. A lot of the traders said to buy the banks. What do you think? That's a that's a great question. The banks' earnings have been horrible over the last couple of days. KBE, this is a big bank ETF. Relative strength 26. That means that 74% of anything that you can buy in the market has outperformed this. It broke below the 200-day moving average up here at 44. It's now at 27. You do the math. I don't want to own banks here. If I did, my first entry in a bank would be if it got back above the 21 with a break below the 21. Well, guess what? 3 days later, you broke below the 21. You got to have be able to put your ego in your pocket, recognize that you're wrong, and move on to something that's working. I've recovered. What I'm doing is reading questions here. I've recovered. I hope you figured that out. I've recovered about half of my losses. I'm afraid of another drop to the lows. Can you give me 3 or 4 rules that I can apply to my stocks? I'm scared and I need to protect my capital. That is a fantastic question. I think the whole approach that I talked about here about finding the relative strength stocks, making sure they're above the 200-day moving average, making sure they're outperforming as the market continues to go higher. And above all, when you buy something, don't ever let it get more than 10% below where you bought it. Also take smaller positions. If you take a 5% position and it loses 10%, that's only a 0.5% overall impact to your portfolio. That's easy to recover from, and that's why you have to keep your losses small. Don, do you guys do this for people like me? I have a 401k and it's terrible. Or is there a subscription? Well, we give a free subscription, and that's our videos 5 nights a week and our podcast on the weekend. I give a 21 over 21 list. Those are the best stocks in the market. If your 401k only allows you to trade mutual funds, for example, a very positive or a very common mutual fund in 401ks is Fidelity Contratrend. It's one of the best. It's not. It wouldn't have protected you in a bear market because these things have to stay 95% invested. So yeah, this thing dropped from 15 to 1050. That's a 35% loss, 30% loss. And now it's coming back here, but apply the same rule. Don't own anything under the 200-day moving average for anything that you own in your 401k. And if you have a 401k with a brokerage option, we do manage some of those. Email Danny and he'll give you the details. That's dan@revereasset.com. Okay, I'm lost. If you sell, how do you know when to get back in? My guy at Edward Jones never sells. We know your guy at Edward Jones never sells, and that's why people are leaving Edward Jones to come to Revere, because we have rules to get you out and get you back in, as I just showed in the last 45 minutes on this video. Not a question, just a comment. The investment committee on CNBC's Fast Money sucks. Well, I would agree with that. Turn off CNBC. The only time I watch it is about in little 5-minute drips and drabs when they have a major announcement like the jobs report or the Fed announcement, and then I'll listen to what the Fed chairman says. But that it gets inside your head, and they all have an agenda. Turn it off and just follow what's actually happening, not what somebody's opinion is. Don, can you cover how to become a client? I like how you handled markets. It's so easy to become a client. All you got to do is fill out some online paperwork, email Danny, dan@revereasset.com, and he'll get you started. The process takes really about a week to move your, sometimes a little longer depending on if it's a 401k or not. But we get the account open with some simple paperwork, and then we initiate the transfer. Don, I own INSG and mRNA. Can you take a look at them? Okay, INSG. Inseego Corp, very nice. Telecom infrastructure. I'm guessing that this is probably a 5G play, and you really couldn't be in a better stock. Relative strength rating of a 99. Obviously, it's very volatile. It's gone up pretty much straight up from 650 to 12. I mean, I would have taken something off the table on this, but I'm not telling anybody to buy or sell. I've got my rules. You've got yours, but you're in a winner, unquestionably. And mRNA, see, now you're just showing off. You got stocks that are at all-time highs. Congratulations. That's exactly what we're trying to do here. Moderna, I don't know how you pronounce it. I think they've got a something with the coronavirus. And again, relative strength above the 200-day moving average, strongly above the 21, near all-time highs. This is what we're looking for. Most of the stocks that I that I showed that we were trafficking in was is this type of stock. Can you explain how you hedge? Absolutely. For example, right now, the portfolio, the Grotexian portfolio is 40% long stocks. Own 11 positions, and it's about 40% of the portfolio. I've got about 15% of that hedged by owning PSQ and by owning SH. These are things that go down. The PSQ goes down as the NASDAQ 100 goes higher. Don, why the heck are you holding the PSQ when it's going lower and the QQQ is going higher? Well, what I'm doing is smoothing my equity curve. I wouldn't own 11 stocks if I didn't own the PSQ. I'd have, and I think I mentioned this, maybe I'd have 3 or 4 stocks, but this hedge allows me to get into the things that should outperform 2 to 3 times what's going on with the index. So I'm okay with losing a little bit in the PSQ if it allows me to have these, 12 to 20% winners that I just detailed when I looked over the stats of the things that we've been trading. So really, it's just a way to smooth your equity curve while the market is in question. There's nothing worse than getting 40, 50, 60% invested and you get a big drop like this. This really cushions against that. So if things get all clear, I'll slowly either take off the hedge. I talked about that with the equivalent of letting the balls in the swimming pool underwater and how they bust to the surface. That's how they're acting, and it goes higher if you take the hedge off. But meantime, if they turn south, you can get stopped out on them. I showed 2 stocks that didn't work, and you can also very easily increase the hedge if the stocks are still holding up okay, but the indexes are breaking down. But if the indexes continue reverse course and break down, all these leading stocks that we have now, we're going to be locking in the gains on them and getting down to maybe a core of 5. My favorite 5 are Vertex, Microsoft, Amazon, Dexcom, and AMD. And those would probably be the last 5 to go. First, I would cut them down to maybe a 3% size. That'd be 15% long. And if I have a 15% hedge in PSQ, I'm effectively flat in my portfolio. Tim's been using gold, GLDM, and bonds, TLT, long-term bonds, as a very effective hedge also. One distribution day within 3 days of a follow-through day. Yeah, we did have one. I've been taking the follow-through day with a little bit of a grain of salt because of the way the market is. It's not a follow-through day that happened after a slight market correction, 10% pullback. It's a follow-through day that happened after a 35% pullback. And I know that if you get a distribution day within 3 days of a follow-through day, the rally normally fails 90% of the time. So that's something that I'm keeping in the back of my mind, but I'm not making decisions based on the fact that it's a distribution day or not. All the stocks in here, there's no participation metals. they don't get a medal just for being in the portfolio. They either need to perform or they're getting kicked out for something that will work. Feel free not to answer all my questions. I know it's time permitting. Let's see. Cloudflare net, is it a leading stock sales earnings other than its RS rating? Let's just say that it's good enough to be in my portfolio as of right now. I've read the story. I'm impressed with the story. I like the relative strength, and I'm not supposed to show the sales and earnings on here when I do these demonstrations because it's proprietary MarketSmith data, but it's fundamentally sound enough. Sometimes something won't have earnings, but if it has strong sales growth, that's good enough for me because eventually that sales growth either translates into earnings or it translates into a failed chart, in which case I'll be out of the way. Please review IHI. Medical device ETF, big sell-off along with the market. I like how the relative strength is trending higher while it was coming down, and it's also trending higher as it's gotten back up to the 200-day moving average. This is fine. If you wrote it down, you took a hit, but you know that already. But now you've gotten it back. It's above the 21-day exponential moving average. A little bit of resistance here at the 200 corresponds to resistance on the left side of the chart here. But hey, 86 relative strength over the last year. Only 14% of the stocks in the market have outperformed it. So this looks fine. What resources do you use to find your leading stocks? I'm constantly researching Investors Business Daily. I read a lot on Twitter. I'm just reading all the time, and they're there. You can find them. And then I do a lot of scans with MarketSmith as far as what's near new highs, relative strength near new highs. I couldn't do my job without MarketSmith and have a steady source of leaders. And to me, this blue line here is the most important thing, and that's your relative strength line. This is your 1 year relative strength line. They also give relative strength ratings for 3 and 6 months. I look a lot at 3-month relative strength to guide me to the leaders. Is there a trailing stop percentage that you recommend for those who can't always watch the market? You should determine your stop when you buy something, so it's not a percentage. Well, it is a percentage. You should commit yourself to never losing more than 0.5% of your overall portfolio. So calculate what that is. If it's if you got $100,000 portfolio, 0.5% is $500. So then you say to yourself, how many shares can I buy if I'm wrong on this stock? So you look at your entry, you look at where your stop would be, you buy the equivalent amount of shares to give you that position size. The more volatile the stock, the smaller that position size is going to be. But if you can't watch the market all the time, that's the way to do it. Should I wrap up profits on Netflix? That's a great question. I would say partial. This isn't going to keep going like that. But it's clearly a leader, and you will get a chance to buy it back in a lower risk entry when it touches the ADMA. That's the very faint pink line here, or it'll touch the 21-day. I mean, just look at history here. No matter how high it goes, it always pulls back to these, you watch Tim's videos, he talks about it all the time, regression to the mean, those 3 ATR charts that he puts up. What do you think the probability is that the market retests the lows? I don't know, and I don't care. I mean, that sounds a little crass, but my approach to the markets goes on what they're doing. I don't think in what happens if it tests the lows. If it tests the lows, my hedges will make money. I'll get stopped out on my stocks. I'll lock in profits, and that's that. I have no idea if we test the lows or not. But again, when you've got an agnostic approach to understanding what the market is doing and not predicting and worrying and hoping about what it might do, you don't worry about things like that. Netflix has been good. Thoughts on Roku? Let's take a look at Roku. They pre-announced earnings, which was responsible for this big gap up. It's pretty good. It's above the 21 and it's above the 50. I would say if it fills this gap, you've got a little bit to worry about. If it breaks back below the 21, it's a sell. Probably run into some resistance here if it makes it up to the 200-day moving average. But Roku, they're in the right business. Leisure, you buy TV now, it's got Roku built into it. Streaming, everybody's cutting the cord. It's a fundamental story, but I definitely wouldn't have thought that with a strong fundamental story, it could drop from 169 to 59. And that's why we have sell rules. Okay, a couple more, and then it's 5 minutes before the hour. We're going to wrap it up. Was there a day in the markets that made you convinced we were in a mini uptrend? Yeah, that was the follow-through day, but really it's the action of the 8 stocks that I had my eye on, how they were reacting versus how the market was reacting. We don't pick the bottoms here. We had a huge lead on what the S&P 500 was doing. Our job is to get out of the way when the markets are acting poorly. We don't try to pick bottoms. If we would have tried to pick a bottom, we probably would have tried to enter a bunch of stuff here, and then we would have got stopped out, headed all the way down here. You know, I talked about some of the things I bought that just didn't work out, but 6 of the 8 that were on the list have maintained very good relative strength and performance, and there wasn't a particular day. It's just a matter of what the individual stocks were doing. I would say this day here, probably on 4-6, we already owned quite a few things by then, but when you had this makes this an island low. I thought we spent 3 days below this faint pink line. That's the ADMA, this big gap up above. It left this in the wake and got back above this prior resistance. That was probably the day that I got more confident. But again, the stocks were acting well with that confidence. That's what I would say to that. Tim has mentioned a few times how large companies like Cheesecake Factory are simply refusing to pay their rent, like AMT. AMT is back to its highs. AMT isn't a traditional REIT. AMT owns cell towers. They are classified as a REIT because they have committed to paying out a certain percentage of their earnings as dividends or repurchasing shares. So 5G is huge. Anything that's made it back to its high, you got to keep an eye on and dig a little bit more below the surface. I've owned AMT several times in the blue chip income portfolio because of its yield. This and SBAC, same situation. They own cell towers, and 5G is huge. They make money off of the land that the cell towers sit on. Well, they own the land that the cell towers sit on. They lease out the cell towers to the telecom companies, and then they just print money. And CCI is the third one. They all look the same. CCIS back in AMT. So they're not traditional REITs. There are like 10 different flavors of REITs. Ones that own commercial real estate are in big trouble. I would avoid those. Anything mortgage related, I think, is an avoid. Something like DEA, which rents out properties to government agencies. I guess they're counting on the government paying their bills. Here's a REIT that's, doing very well, as opposed to something like Simon Properties Group, SPG. People aren't shopping brick and mortar, and that's why 91% of all stocks have outperformed SPG over the last year. 12:59, we're going to wrap it up. Thank you very much for attending. I love doing these. They're stressful preparing for it. Sometimes I always think I'm going to fall on my face for some reason, or the technology is going to break down. But hey, we're taking it a day at a time. We've got our rules in place. You follow us, you can put those same rules in place. This is the hardest game. I know. I hear people tell me, I think eventually, I'll just quit my job and trade full time. I've got 50,000 saved. Is that enough? The answer is no. It's the hardest thing that you'll ever do in your life, trying to make trying to make a living trading stocks. Not too many things higher, certainly things more dangerous, but you're competing against computers and minds in finance that are the finest in the world. And it's not an easy thing to do, but with the framework that we provide, it's been time tested and proven that you buy the strongest stocks in the strongest markets, in the strongest sectors, in the strongest markets, and cut your losses and let your winners run. That's it. Thank you very much. Everybody will get a recording of this that has signed up, including those that attended live. We appreciate your support. Have a great day.